Welcome everyone and thank you for joining us. This is the second angel education event of this year. This is the first deep dive that we're doing though. This is a deep dive in diligence, and it was hard for us to figure out what to call it. Because at first we tried to call it common sense diligence, and people told us, well, it sounds too simple, I know enough, I'm probably not going to attend. Then we said, well, no, we're going to be digging in and really equipping people with the tools to do better, more substantive diligence. I think people thought it was going to be an Excel course, right? And we'd just be digging into the boring pieces. What we hope we did with the title here is to talk about why we do this, right? To make better investments, drive smarter returns, and basically to get to the core of what we try to do as investors, which is to identify opportunities, screen opportunities, evaluate them, and then ultimately decide to make an investment. So we would like, before we move on, just to thank the Burton D. Morgan Foundation. Vicki Borer is here, and we'd like to thank them for their support. The Burton D. Morgan Foundation is really the leading in the region and really a thought leader nationally in entrepreneurship education. They work with and support a number of the universities, and they were kind enough to see the value in what we were trying to do here by bringing additional information and insight to a community of angel investors, both those who are members of North Coast and those who are individual angel investors. We'd also like to take a moment to thank our Innovation Council supporters. This is a growing group of companies and institutions in Northeast Ohio that has decided to invest some time and some capital in the early stage environment. They are showing up, as you'll see many people here today, with a little blue tag. They are open to meeting entrepreneurs, helping drive innovation, and we think it's a very good thing for what we do. The agendas are on the table. We're going to have a couple short presentations up front and dig into 4 panels. On the panels are going to be some North Coast members, some non-North Coast members, some traditional angel investors, and some CEOs. I'll be doing a lot of the question asking. We're hoping that there'll be questions, comments, and maybe even a little bit of pushback from the group. So feel free to voice your thoughts as we move forward on these topics. Has anyone here ever heard of Ernest Shackleton? One? Okay. So we have more polar explorer people here than I would have thought. In 1913, the story goes that he was looking for a crew to go with him to Antarctica, and that this or something like this advertisement was offered. As was pointed out to us recently at an angel event, his lack of salesmanship and maybe candor probably is something that resonates with many of us, because as he characterizes it here, hazardous journeys, small wages, long months of complete darkness, you might say sometimes years of complete darkness, and in addition to it being a doubtful outcome, there's a little bit of a chance of it actually going well and having recognition of success. So part of what we do is with the acknowledgement that this is really hard stuff. It's hard for the entrepreneurs and the teams to be sure, and it's hard for us as investors. Before we talk about how we are thinking about evaluating companies, we wanted to talk about what we're not going to do, because there's a continuum of investing from idea stage all the way to IPO and exit. And there's too much information there, and diligence is really different at every stage. This slide seeks to characterize how much money and what types of activities are going on at each stage. And obviously, depending on how much money you're going to put in and what the company needs to accomplish, the diligence may look a little bit different. Where we're going to focus here is on the seed stage. So these are companies that have at least a small team, that have a minimum viable product, potentially a couple customers. If they're life science companies, they have a prototype that's at least been demonstrated in animal clinical models and would soon go to human clinicals. These are not companies driving millions of dollars of revenue. They don't typically have even 10 or 20, 30, 40 people. They're very early companies, and therefore there's only so much for us to evaluate in the diligence process. At the seed stage, most of this stuff seems crazy, because if it wasn't, it wouldn't have a big opportunity. We're not looking for a better pizza shop. We're not looking for a slightly better way to service customers. Most of the ideas that we're seeking to fund are more revolutionary than evolutionary, we hope, and have a big impact, and therefore a high potential for risk and failure. The only way, if you're going to invest in seed stage companies, to feel like you have a couple of these crazy ideas that might just work is to look at a very large number of opportunities. This is the North Coast funnel over about the last 10 years. And as you can see, for us to invest in 50 companies, we had to look at nearly 3,000. Ultimately, only 4% of the companies we ever looked at went into a serious form of diligence. And we think that one of the challenges as individual investors is figuring out where to put your time and energy. It's one of the reasons why we think angel investing is a team sport, regardless of whether you're part of a group or not. The average cap table that doesn't have a group like ours on it still has 20 or 30 individual angel investors. They may have invested $25,000, $50,000 each, but for a company that's looking to raise $1 million or more in one or more seed rounds, it's going to take a small village of angel investors, and therefore in the diligence process, in the deal development and syndication process, we think it makes sense to contemplate how you as an individual may work with other individual angel investors, groups, family offices, or small seed VCs. What makes it even harder is that the result of this angel investing is a large number of active companies. Companies that have demands in terms of additional funding, requests for connections and introductions, and it's another reason why it's a group activity. And ideally, as an individual investor, you won't have to serve on the boards of all these companies. You won't have to help to structure future deals and exit events. You can rely on some of your other investors. So at the beginning, it's really hard, but we try to do far more than watchful waiting with these companies. We try to get engaged and to move the needle. This, hopefully people can see most of this, and I'll explain what's going on here, but this funnel is really the whole context for what we're going to talk about as far as diligence. This is CB Insights data. They looked at 1,100 companies that raised a seed round in 2008, 2009, or 2010. And those companies went on to either do great things, grow, raise more money, be sold, or to fold. Right? They were not ultimately successful. What we see here is of the 1,100 companies that raised a seed round, less than half raised that next round. Most of those companies that didn't went away. So we as investors, we're looking at, in our 50 companies that we invested in at North Coast, are a part of the types of companies that are there at the top, those 1,100. And establishing a diligence process, I think, has to contemplate what is going to happen at companies at each stage, and assessing whether the companies you are investing in have the ability to either exit at one of these stages or to raise more capital. Interestingly, 300 of these companies exited. And I put air quotes because the overwhelming majority of those companies, over 210 of them, exited for less than $50 million. And the average company that went through the full cycle and raised 5 rounds raised over $40 million. I think that's a way of saying that the majority of the exits did not provide a return or a meaningful return for early investors or probably for the founders themselves. It's really a subset of those exits, perhaps 3%, 5%, depending on the size, that had an exit of more than $100 million, and therefore it was a strong outcome. According to these numbers, they tracked 10 companies that sold for $1 billion or more. So about 1% of the companies were unicorns. Part of the reason, again, seed stage investing is hard is because the ideas are unformed, they're unfinished, and it's up to us in the diligence process to see a little bit beyond what's there in front of us at that moment. We all have enthusiasm, we want ideas to work, our entrepreneurs have enthusiasm, but it's not hard to look at our actual experiences over the years and to find situations, some funny, some painful, right, that mimic our actual experience. What we try to do here is just to lightly characterize why companies are getting involved in business, what their reason for being is, and perhaps why we fall short in our diligence efforts if we don't notice some of these issues. So one, a lot of companies will come to us and say, well, we're faster, right? Faster isn't always better. Faster can be dangerous. People aren't always going to pay for faster. Sometimes the value proposition that we're presented with is not in fact real, and that's part of what we'll talk about here as well. Just because everyone has to show one video, we wanted to acknowledge that sometimes as investors, we can get captivated a little bit by ideas that seem fun. because if they're fun and they're interesting, it seems like they would make sense to us, and somebody would ultimately buy these products. So, Daniel, as a relatively new father, pointed out to me that only the father is wearing a helmet and ear protection. Interesting. With 3 kids, I think I'm already not thinking about that. What's interesting is I think we probably see 1 or 2 companies a week that are a flavor of that, right? Something really interesting and something kind of fun, but that someone will never buy, that will never be a business. And we try to understand that up front, not just for our own benefit, but to try to communicate to entrepreneurs what we're thinking, whether it's right or wrong, to give them the benefit of that perspective. So there are a lot of reasons that startups fail. We know that, and we think contemplating the reasons that are most likely for failure is a helpful exercise when thinking about diligence. The 2 that really stand out to us here, 2 of the top 3 are what I'd characterize as our fault problems, right? No market need and not the right team. Those are things that we can and should be identifying, mitigating, or just avoiding right up front. Everything else here is kind of an ongoing acceptable risk of a business as things develop, right? There are a lot of things which are not executed quite as well as we might think. There are new things to be found, but if you ultimately have a problem with your market, you have a problem with your team, you really shouldn't have invested in the first place. And those are the 2 areas we're going to talk about on our second and our third panel tonight, is how to evaluate just those 2 things. The idea of no market need is a little oversimplified here. There's always a market need. There's always some interest. There's always a customer or 2 that we can call. But in reality, there's the issue of identifying big problems versus little problems. And we don't want to be in the business of investing in Band-Aid type problems, right? We want to invest in companies that are solving problems where you need lots of people, lots of time sensitivity, lots of money to solve. And that's really the only way that we feel we can grow a company fast enough to make sense for our risk model. Follow-on financing is a big part of this also. Diligence doesn't stop with the initial investment. We always want to be evaluating how companies are doing and to take a look at would we make that investment again, and how are we thinking about a potential follow-on investment. As an example, I wanted to share a little bit of data that we haven't shared with anyone yet. These are 5 anonymous companies. They will not be anonymous in a minute, that we all invested in. And what we're going to do is just demonstrate here year by year, their first 6 years, how they did revenue-wise. So the alignment here is these are all either product, software, or healthcare IT companies. Their goal is to sell something, so they're all hopeful that they'll be driving revenue in the early years. And what we see here is that 1 of the companies has $0 in revenue, 2 of the companies have less than 100,000, then 2 of them have between 200 and 400,000. A little low. Typically, now we invest perhaps slightly later stage, but for a seed stage company just launching, being in the mid 6 figures is not unusual. Fast forwarding to year 2, there's 1 company that's kind of broken out here. We see they're all the way up above $2 million. Another is at $1 million, and we start to see some movement. So success, though, is not a straight line. By year 3, we see that the breakout company still is leading the pack, and that company now has over $3 million. But one of the companies that was towards the bottom, kind of in a tie for number 4, is now our second fastest growing company. That said, they're all exhibiting some growth. By year 4, we see one of the companies seems to have stagnated a little bit, and we're starting to see perhaps 3 companies now starting to demonstrate traction. Year 5, it's a little bit of a breakout here, where one of the companies we can see crosses a $10 million line, which is a terrific place because you start to attract additional investors. You become a semi-interesting initial acquisition target, and for doing that in 5 years, that's a strong indication. We also see that one of the companies is essentially straight lining here, flat line, and not making any progress. But at the end of 6 years, all these companies are alive. And we have 1 company here now that's approaching $20 million in revenue, 2 that are above 5. So at this point, we've got 3 companies out of these 5, which would say are doing pretty well. So we'll do the reveal here and point out that the clock of 0 to 6 years for one of the companies, Ahology, they're only at year 5, right? So we stopped there. For some of these companies, they're at year 7, 8, or in one case, year 10. So the short story on what happened, Assurex was sold. It was acquired by Myriad Genetics. They did over $100 million in revenue. They've grown quite nicely. OnShift has continued to grow each year, over $20 million in revenue. We think they'll do over $30 million this year. Unfortunately, Decision Desk did not make it. I was on that board, so I've got some stories to share on that. But despite a lot of focus and time, effort, and capital, that company is no more, and we had a loss as investors. And Exactor, although you see it stagnating there, the last 3 years has grown and is now up to $4 million. So a lot changes over time, and our ability to evaluate and potentially invest in these companies again will drive a lot of the success of our portfolios. So I assume everyone here, and most people are familiar with the Malcolm Gladwell 10,000-hour rule. And I find that both encouraging and depressing. Encouraging because if we all put in the time and energy, we can be very good at something like angel investing. Depressing because we'll all lose a fortune if we're really bad at this activity for 10,000 hours. So we need to find a way as early angel investors to get better at this in a much faster fashion than this. And we think that investing as groups is one way to do that. As we talk about individuals, we're going to just acknowledge it's really hard to identify great entrepreneurs. In retrospect, they stand out. But in this day and age, it's a little foolish to think that it's all a bunch of young white guys, which is what typically venture path companies tend to be, and how venture capital funds invest their capital. But the CEO founders that we see here represent 3 of these, the 3 largest publicly traded companies in the world. So these are all venture path companies, and we think there's a lot to learn from the characteristics of successful founders. Now, this is probably an imperfect analogy, to say the least. I enjoyed it because often as investors and entrepreneurs, we're smiling at each other on the outside, and we're not always smiling on the inside. But it's hard. You've got to meet a lot of people. You've got to figure out what it is you're looking for, and to have a strategy. Otherwise, you'll kind of waste your time and energy as we see. But we think there needs to be a far more thoughtful approach on our part and the part of early stage investors, so that we find better opportunities, so that we use our time wisely, and we also don't waste the time of entrepreneurs who could be talking to customers or investors that may actually invest in their companies. So lastly, we'll just acknowledge again, this is really hard stuff. So we've gone with the philosophy of Einstein and Tyson, 2 very different philosophers, but both having, I think, actionable information here that we can learn from. And having invested in these companies and served on these boards, this is maybe the truest quote I've ever seen about that could be characterized for angel investing, because every plan just gets thrown out once you start. When it makes contact with a customer, when you lose your first big deal, when you learn something. So part of the characteristics that we look for in entrepreneurs are their ability to learn, evolve, and change. So we'll give a brief update here and talk about one of our portfolio companies, which we want to highlight because we're going to talk about it a little bit in a couple of these panels. So Convey is a North Coast 3 company. It's formed by a serial entrepreneur, Sam Gerace, which is a mobile app for identity management. How many people here used to use Plaxo at one point? Oh, less than I thought. How about Bump? Anyone remember Bump? Okay. So these are apps to exchange information, electronic business cards, and those models were interesting and allowed you to socially change information, potentially keep and update information in the cloud. But there were a couple areas where Sam and the founding team thought it fell short. One is you can only have one identity per person. And their insight was that we're business people, we're family people, we have our kids' soccer and athletic teams, and there's a broader basis of information we want to share. The other is that Plaxo and Bump offer no value for the corporate community. And the corporate community invest billions of dollars in CRM systems, marketing automation systems, ways to acquire and communicate with people based on their contacts. So this company was invested in by us earlier this year. It was one of the few companies we invested in completely pre-revenue, pre-launch of a product. And as we've seen its progress over the past several months, I think the risk profile has changed dramatically as they've acquired customers, demonstrated viability, demonstrated a virality in terms of how customers are using it, and also earned a patent, which we think protects part of what they want to do. So the point we make here, and we may make in some of the panels, is that the profile of diligence is very different, potentially from 1 month to another month when you're evaluating these companies. And even within a seed designation, the nature of the companies can and is very different, can be and is very different. So before I hand off to Daniel, I just want to mention that we have a whole series of additional educational sessions. These were identified and voted on by the first 200 people who came to our Angel 101 courses. We gave about 15 choices as to what people would like to see. So we're going to be putting these on later this year. If this is interesting, we hope you'll put this on your calendar. And if anyone here who is not a member of the fund would like to attend one of the upcoming member meetings, just let one of us know, and we'd be happy to put you on the list. Kind of like tonight, people have a drink, they have some food, and they listen to pitches, so it's a pretty low-key environment. With that, I'll pass off to Daniel.
Okay, so we thought it would make sense to spend just 5 minutes walking everyone through North Coast Angel Fund, our diligence process, our best thinking on how we go from identifying to investing in companies. So whether you've had no exposure to North Coast Angel Fund, or you've invested in the first or second fund but not the third fund, or even if you've invested in the third fund but you haven't participated on a diligence team in a while, we're continuously making changes to the process. So I think you'll find it interesting to see our current best thinking on how we move through these 4 steps. So to start with, what kinds of opportunities are we looking at, and are we leveraging our members' expertise to try to invest in the best deals? Predominantly, it's the software and life science companies. On the life science side of the house, it's medical device companies that we're looking at. And as you'd expect, we're looking at for large markets. We're looking for some form of validation, whether that's validation of the product or validation through some clinical trials. We're looking for some form of sales traction, some customers that we can talk to, or some beta clients that we can have conversations with. Or we're looking to be able to see a pretty clear roadmap as it relates to the regulatory pathway, or how companies on the life science side of the house will be reimbursed. And then we're looking for compelling metrics. We invest in these 2 verticals because there should be high margins, there should be some form of recurring revenue streams, and low churn that we can evaluate. And then finally, with both types of companies, we're looking for some type of credible exit opportunities that they'll be pursuing. So to start with identifying, we have a number of different deal flow sources that we lean on, from incubators and accelerators that are those early stage support partners for many entrepreneurs, help them validate their ideas, develop team, build product, to other support organization and funds. For example, Jumpstart represents an organization that provides a lot of early stage support and then has investment funds that operate at a similar stage to North Coast Angels Fund that we will use as a source of deal flow. We're very interconnected with the other angel funds throughout the state of Ohio, so we invest in Ohio, in Ohio-based companies. There's another large angel fund in Cincinnati, Queen City Angels, that we work closely with, Ohio Tech Angel Fund. There's one in Canton, Ohio. There's one in Youngstown, Ohio. We actually, in Ohio, the group of angel funds get on a monthly phone call where we discuss primarily deal flow, right? Deals that we could potentially invest in together and syndicate deals between the group. Our members are a great source. We try to be active at events. There are a number of events. The ecosystem in Cleveland is strong, and there's a lot of different events to attend, and we've met a lot of exciting entrepreneurs at those events. And then we have a website application process. So the first step in identifying is the management team. So myself, Todd, and we usually have a bullpen of interns working with us to review applications that are coming in or executive summaries that we are sent. Usually in a given month, we'll review about a dozen deals. In addition to reviewing the documentation they send us, we will usually set up a 30-minute to an hour-long either meeting in our office or a web conference Zoom call. Talk with the entrepreneur, work through their plan. Coming out of those discussions in a given month, we put our heads together and we try to identify the top 2 deals that we think are most promising to put in front of our members. So that brings us to the screening step. And just to give you a sense, I'm going to start to identify as far as timing and how long this process takes from getting in front of our screening group to investing. In the first week, if you look at screening, every month, usually the second week of the month, we hold an investment screening committee meeting. So we have about 20 Fund 3 members, investors, who have raised their hand and said we'd like to help screen deals initially. We call on them each month, and we will, when necessary, given the 2 deals that we're looking at, invite subject matter experts, either from our Innovation Council, of corporate partners and organizations, or just friends of the fund that we want to lean on and say, we have to know what you think about this deal. And so at that screening committee, we share the executive summaries in advance. Usually out of those 20 people, we'll get 12 or 15 people or so in our office in Mayfield Heights around the table. And the first company comes in and they have an hour time slot. In their first 15 minutes, they give their pitch. They're peppered with 30 minutes of Q&A. As soon as they leave the room, our group has 10 minutes of conversation, and we vote there on the spot. And by majority vote of the Fund 3 members present at that screening committee, we make a decision about either moving forward into due diligence or not moving forward. If we decide to move into due diligence, then that means, again, in roughly weeks 1 through 3, we put together a due diligence team. So usually that screening committee is a good source of diligence team members. Usually we're able to put together a team of 3 to 5 individuals, our members, that complement myself and Todd in rolling up our sleeves and doing the diligence for the company, on the company. Again, we leverage subject matter experts, and something that's new to our process for those who haven't participated in a team in a while, for about the last 4 or 5 diligence projects, we've assigned a diligence team lead, where we've actually tapped a member on the shoulder and said, we'd like you to drive the discussion here amongst the team, as well as the questioning with the company and the entrepreneur, and to also commit to participating in nearly 100% of the diligence team activities to have that continuity from beginning to end. And then I won't run through all the different diligence activities, but as you'd expect, it starts with a data room, a list of requests that we send them, and all the materials from financials to marketing plan to their full business plan that we review. We also are able to review the data room and the diligence that other syndicate partners have done. So if Queen City Angels is passing this deal along because they've already committed to investing $250,000 and we would be the next check to get towards $1 million or $2 million round, we're able to leverage and review that diligence as well. We invite the company, after they've been voted to move into due diligence, to present at our next member meeting. So they come to that meeting, they present to basically give a larger group of our members some exposure to the deal and an opportunity to join the diligence team as well. We kick off our process with a 2-hour kickoff event at our office. The entrepreneur comes in, the team's around the table, and we get the majority of our work done there. We schedule 3 1-hour follow-up calls, usually over the lunch hour, over a Zoom web conference, when we're able to put our heads together after our last discussion and decide which critical topic we want to address next with the entrepreneur. And then as we work towards the end of that 3-week period, what we do is we get the team only together and we start to have some discussion to align around a recommendation. Do we feel strongly enough that we want to recommend to the broader membership of the third fund in this case that we should move forward with an investment? And if we arrive at a majority decision, we like to arrive at a unanimous decision and work towards that, then we put together a written diligence recommendation, and that brings us to the final investment step. So after that diligence team has their written recommendation prepared, at the next member meeting, so now you've benchmarked 30 days right since that company presented as they were moving into diligence, at that next member meeting, we will allow the company to present, and then that diligence team will step up in front of the group of members, the company will step out of the room, and that diligence team will defend their thesis, essentially, why we should move forward with investment and what diligence they did. That triggers a $250,000 investment. We might have some additional deal term negotiation and final signing of deal docs, and then we move into a process where our members have the ability to make a decision about making a sidecar investment, and at that point we would start to syndicate the deal to other funds if we're leading the investment. So beginning to end, that's our process. We try to be entrepreneur friendly. We've received a lot of feedback that this 30-day process is attractive to them, it's attractive to our diligence teams, and we think after looking at the data, when we extended on to 60 days and beyond, we were simply prolonging a no. We weren't getting to a yes decision in that period. One other point, if there are any entrepreneurs in the room, a change in our process, we aren't charging a screening committee fee anymore. So before we charge a $300 fee to basically confirm commitment of the entrepreneurs they move through this process, we no longer charge that fee. So I know that's a lot. We have a handout that outlines that process as well, so you can revisit those notes. But with that, I'll put Drew and hand it back over to Todd.
Thank you, and we're going to ask our first set of panelists to come up. As they do, we'll adjust and prepare for them. We'll ask them to give a 30-second overview on who they are, what they do, favorite colors, whatever they like. And I would be remiss if I did not mention one thing, and that has to do with this. What we have done for our angel education events so far is, as a mild inducement for everyone here to stick around until the end, we have a little drawing. Any of you who are familiar with Kentucky Bourbon and Angel's Envy know this is a fun bottle to drink. We celebrate a lot of our victories with this. Fortunately, we poured out a couple bottles commiserating over the losses, but we're going to have a drawing at the end. You have to be here to win. So please do stick around, and we will pass this out, as well as we're going to draw one other name, which will receive a little bit of a VI package for a upcoming event at the clinic where John Doerr, a kind of granddaddy of venture capital with Kleiner Perkins, is going to be speaking in 2 weeks at the Intercontinental at the clinic. So there will be a couple passes there. There are other opportunities there, though. The event in general, although it's limited in tickets, is free. So if people are interested, we think it'll be a lot of fun to hear from someone who's deployed billions of dollars out of a fund over the past probably 30 years. So with that, we'll introduce the panel.
Welcome, everybody. I'm Clay Rankin, Managing Director of North Coast. Todd and I got North Coast started a little over almost 12 years ago this summer, and been doing this early stage investing for the last 22 years full time.
Michal Soclof, I'm the principal of Matrix Equity, a private equity firm specializing in high-tech investments, real estate, and other business ventures. My background is in software technology and computer engineering. I've been involved with many companies, both from large corporations, research, as well as startups, and universities as well. I'm a North Coast 3 member, very active in the screening committee, and I'm in the due diligence teams.
I'm Alan Brenner, North Coast Fund 3 member for the last year and a half or so. I'm a management consultant. I consult tech companies, startups. I've been an angel investor since about 2011. I spent a lot of my career on the West Coast and Silicon Valley working for Sun Microsystems and then for BlackBerry. Great.
And don't forget, NCAP Member of the Year.
So I think next panel will superimpose the award that we gave you, just so the prestige factor is there. So thank you for pointing that out, Scott. So Alan, we'll start with you, not because you're a member of the year, but it's a nice bonus. When you see that CV Insights funnel that shows the 1,100 seed stage investments and how they evolve over a 6+ year period, what do you see that you think informs what our expectations should be and what the proper mindset should be going into this angel investment activity?
Yeah, that's a really good question. So 9 out of 10 deals don't exit well, don't make money for the investors. The remaining 10%, some do really well and others just do okay. So it's it underlines the importance of looking for really high quality investment, and by that I mean a high quality market opportunity, a high quality leadership team, and and a solution that looks like it's on the way. Equally important, I think, and maybe spread over all 3 of those things, is a culture in the company of learning from experimentation and then acting on what they're learning. So it's you're trying to look at the entity in flight, because their chances of success depend on those attributes that I just went through.
And Michal, at the seed stage, what are you realistically trying to accomplish in diligence? What do you think is doable or knowable?
So a lot of what we do at the initial stages is really get a feel for some of the topics that Alan explained. One of them being, what is the problem that this company is trying to solve? Is it innovative? Is it a problem that many people have? As Todd was showing, is it something that's going to be relevant to other individuals and many people? But part of that as well is, are they really doing something innovative? Are they solving a problem in a new way, in a unique way, in a way that has not been done before? And those are the top 2 that we look for. I would say the other aspect really is the part that's involved with the actual entrepreneur and their team. Are they experienced in building companies? Are they experts in their field? Have they actually looked at the problem? Have they looked at their competitors? Because sometimes we do see companies that have a good idea, but other companies are trying to solve this problem. And I think another aspect that becomes very important, and this is something that I drove down on a lot, if a company comes and they start throwing out a lot of buzzwords, so I hear blockchain technology, machine learning, augmented reality, artificial intelligence, between the team that's in the room, we have that expertise, and we'll start drilling. The companies that have made it through are actually doing machine learning, are doing blockchain and such. The ones that aren't, and unfortunately we've seen most of those at the beginning, we ask them, they'll say, yeah, not really. We just thought it'd be interesting. Well, that's enough to start. I mean, you're not out there to impress us that you know what the buzzwords are. You're out there to show us that you've identified the problem, you have a creative solution, and you have an approach to solving it. Those are 3 key aspects, and you need to have all 3 to move forward. And one thing I'll add at the early stage too, you get a feel for the entrepreneur. There is a little bit of the dating aspect that Todd mentioned. You do need to get that intangible, that you trust the individual, that you like the way they present, and that you like their personality, meaning how they want to work with you as an investor and how they're working with their management team and with the other people that they're trying to solve the problem with.
Can I just get inside your head for a moment? As you're in the early stages of diligence, are you practically trying to find a reason to say yes or a reason to say no? Which of those are you solving for in diligence?
Well, realistically, I wouldn't have been doing this for 22 years if I wasn't looking to invest. But I think this is really a little bit of a stylistic question. I think from a starting point, going into my first meeting with an entrepreneur, I really try to go in with a neutral eye. I really want to see whether there is an opportunity there, and just sort of looking at my own reactions as I go through this diligence process. What I find myself doing is saying, okay, this guy has demonstrated, or gal has demonstrated that there is the real opportunity out there. There's something really substantive. That this person is really driven by passion and a degree of knowledge about what they're trying to do. I find myself looking for reasons to invest. And once we've kind of gotten over that hump of saying, no, this looks pretty interesting, then I find I switch, and I'm starting to look for the reasons not to invest. And what are those kinds of things? And I think they're varied. It probably starts with the entrepreneur and looking, for example, at the experience that entrepreneur has had. The reality is, here in Northeast Ohio and throughout Ohio, we don't have a lot of serial entrepreneurs. These are people who are doing it for the first time. And they are in a big learning curve. So the question I ask myself is, who has that entrepreneur surrounded himself or herself with? Who are the advisors? Who are the boards that are going to really help this person succeed? And if we see this person really going it alone, not particularly coachable, well, that's a real fast one to run away from. I just can't move forward on that front. I think that understanding then the IP or the specific knowledge that this company has that is going to give it some real substance down the road for a potential exit partner. Is this something that's going to have long legs, or is this just a shot in the dark? I think as I look at other things, is there a reasonable understanding of the dollars needed to get the company to the next value inflection point? Does that entrepreneur really understand what it's going to take to get there? And I would say, judging by the chart that Todd had up earlier, showing how long some of these companies take to get at traction, most of the entrepreneurs do not have a really deep understanding of what it's going to take to get to that inflection point where the business starts to take off. It's really tough to get there. It's hard to predict, and if they haven't a clue, then you're really behind the 8 ball right out of the gate. And then I think another big piece of the equation, as you think about the maturity of the company, is, do these people understand how they're going to get to an exit? I mean, we're in the companies to get a return on our investment. And I think what we see in some cases is that the entrepreneurs have an idea, they're excited about their idea, but they have no clue how they're going to create substantive value for their investors. And it's hard, but if they don't have knowledge of who the strategic partners might be, an in-depth knowledge, they're probably never going to position themselves effectively to get to that end point. So you start with, yeah, we're excited about being here. This is a fun activity to do this kind of early stage investing, but then you really got to dig deep, and I think you really have to question whether the prospects are there.
Then Alan will ask you the valuable questions. So most people here probably read Blink or heard about Blink, right? That there's thin slices, very quick reactions that we all have to people making decisions based on historical triggers or pattern recognition. The other extreme is Moneyball, right? We're looking at every possible statistic, kind of putting it into a master equation and coming out with an answer. How does your brain work, or how do you think evaluators of these types of companies should try to process information and come to conclusions?
Yeah, I want to sort of riff on the points that Claire made, because I think it is a I guess the first point is I try to focus on markets and technologies that I know something about. Meaning that I have that base of link, if you will, thin slice capability. But you have to be, just like Clay was describing, coming in positive, but then ask questions and be critical. You have to do the same thing. You look for patterns, but you also have to be skeptical about whether your understanding is actually applicable in this particular case. So I think it's really important that I like to approach deals where I know the fourth question. I know I've seen enough of the history of this space to be able guess what problems are important problems that the company we're looking at has to think about, and then ask questions. And like Clay was describing, I want to try and get inside the head of the entrepreneur. I want to be able to elicit enough information back from them that I can sort of try on their point of view and look at the world through their eyes. And that's a position that I find helpful in asking the then critical questions to find out if their thinking makes sense. So you end up going back and forth. You end up between thin slicing and critical evaluation, and you're trying to look at the world through their eyes and ask a series of questions that will tell whether that thin slice result is real. One of the things that I try to do is think about the problems they're facing and whether they have answers to them. And I need to go at the deal opportunity multiple times to get a feel for what all those problems are. And a lot of deals fail in that process because there's just hard problems that they haven't thought about or can't be solved. The most important class of those problems is, are they too early or too late? What often happens with the startups is they have a great idea, but the surrounding technologies and infrastructure is not there, and the effort to make the deal foot, make the business foot, is going to be too great for the funding they're going to need, which will be dilutive and therefore not profitable for the investor. The other problem is they're too late. They have a great idea, but once they bring it to market, they're going to be susceptible to a fast follow by somebody with more money, and the position won't be viable. So that's often what I'm looking for. They're too early or too late.
Michal, to the top of the funnel, what do you need to see, or what boxes do you need to check to take a one-on-one meeting with an entrepreneur? Not just, again, for it being a good use of your time, but a good use of their time.
I think part of it is, as Clay was mentioning, what we have in our area here are a lot of young, not necessarily young in age, but young in experience of being an entrepreneur with exciting ideas. But part of that is the coachability, and we don't really play judge and jury when we come in a due diligence mode. We're trying to evaluate the idea and the person as well. And what you want to do is see if that person is coachable, meaning they may have a really good nascent idea, but they're not quite sure how to raise the money, they're not sure to develop the idea. So in order to take the one-on-one, you want to see that excitement, you want to see the spark, and you want to see the sophistication in solving through the problem. And that's not related to age, to gender, or anything like that. If you see that, and a lot of that is part of the gut feel, after you have a chance to talk to them and see whether their knowledge base is in the area, and then to take the one-on-one. So we typically do end up meeting with the person personally. I can only think of one example of a company that we did not meet in person, the CEO. We actually did a follow-up with them. It was Remesh. I don't think we ever met Andrew in person, as far as the due diligence team. But we really drilled down on him in many one-on-one video type conferencing, and asked a lot of difficult questions. But I do like to get to know the person, to get to know their experience, their excitement, and also their understanding of what it is they're trying to achieve. Are they trying to grow into a large company? Are they trying to get a quick exit? And do they have, back to, it was the cartoon that talked about the square wheel. So the idea of, I think the key to that is also the ecosystem that they're developing it. So in Northeast Ohio, our ecosystem is different than the West Coast or the East Coast, both in the people that we see, the ideas that we have, and very importantly, the angel investors that are in our area. A lot of the money that is available here for investment comes from a different kind of background. A lot of families, multi-generational, money from manufacturing, from real estate. They're used to seeing buildings and property and widgets that are physical devices and machines and equipment. And trying to get them to understand that the startup world operates in a different mode with a different mindset. So the entrepreneur that you're talking to, you also have to make sure that you can sell them to investors. And both investors, in our case, members of our fund, or follow-up investments that may come from eventually venture capital or in other areas from Cleveland. So I think a lot of that is part of what follows. So.
Great. And Clay, and as you're going through the evaluation process, how do you know you're done? What tells you that, yes, I've checked the box, whether it's on an even area, like competition, I'm now comfortable with it, I'm moving forward, or the entire evaluation, I'm either ready to fold the tent, or I'd like to make an investment?
That's a $64,000 question, because I don't think you ever know whether you're done. I think the reality is you could always look for more. I think that the notion, however, of trying to drive this into a 30-day window of making an investment decision, I think we saw over the last 10 years that, as Todd has described, you're not gaining a lot of insight as you move into month 2 or 3 of asking questions. If that entrepreneur hasn't been able to convince you, there's really something missing. Now, I would also just maybe have a little caveat there, which is I also sense that as time went on, we began to see a little bit more clearly how that entrepreneur operated. And you know, when they first meet you, they're on their game. They've got their presentation just perfectly primed. But you know, month 3, they're maybe not always so sharp. And you start to then ask yourself, can this person sustain the right kind of activity for making his or her business successful? I think that there really isn't much point to drag it out. Generally speaking, I think that it's perhaps hard for many of us who think about doing this individually. It would be an overwhelming task in many cases to do deep due diligence all by ourselves. But when you pool the resources of everybody in the membership, the people on the committees, then you can do a lot in 30 days to understand the market, to see how the entrepreneurs are performing, and to think through all of the other kinds of issues that I highlighted before. And I don't think there's a lot to gain dragging it out.
So the last question for this panel will be directed towards Alan, and ask you to take 30 days of diligence and distill it into 30 seconds of answer here. For Convey, which was pre-revenue, pre-product, the early continuum of seed, how did you and the team come to a point where you became comfortable that there was a proposition that made sense for us and our fund to deploy $250,000 into effectively lead a $1 to $2 million road?
30 seconds.
60 if you need.
Well, they're pre-revenue and pre-product. So I think the diligence team became convinced that the category, not a particular product, but there's a category there that was underserved. And I use the word category because I think the Convey technology and Convey concept could be pointed to a few different adjacent segments. And I think at the point the diligence was done, we had a general idea about where they were aiming, but it was still early. And I think that if I can see if I can articulate this a little more specifically, the Convey idea, right, is that the existing business card solutions, physical cards, or other online solutions, digital solutions, are one-to-one. I hand you a card, you hand me a card. There's an opportunity there to exploit the availability of mobile phones and the internet to create essentially four-way relationships. Me and my company affiliation, and you and your company affiliation. And if I change jobs, then you retain a relationship with my company if I change jobs, or vice versa. So this, the presence of mobile devices to make it easy to handle a digital solution, the presence of pervasive internet networking, and the idea of a two-pronged endpoint in the connection seemed like it had a good chance of finding a segment where it fit. And so since we did the due diligence, the way it's got traction in retail relationships. I think the term the industry uses is clienteling, where if I'm a retail sales rep, I can hand you a digital business card, and that allows ongoing connection between the retailer and the consumer. That wasn't what we discussed in the diligence, but it did validate the thesis we had in the diligence process that this was a category where they would find footing. So you have to be a little bit imaginative and also attentive to the sort of secular technical trends that are creating opportunity that may span multiple particular product opportunities in order to provide us with a sense of what's possible.
Clay, last comment?
I'd just like to add on to what Alan was saying. I think one of the things that Sam did with his team that really caught my attention for a company that didn't have a product yet and was really conceptual was the effort that they took to go out into the marketplace and poll, I think it was over 100 prospective companies, to understand their level of interest on the one hand, and then their willingness to pay a certain amount of money for that service. I don't think we have very many of our portfolio companies who have actually done that kind of advanced work to understand what's out there really in the marketplace. Now, that was no guarantee that those companies are going to step up and actually pay the money. But we knew that the value proposition was going to come through sort of the corporate revenue stream. And that was, I think, a very convincing undertaking that company did to give me comfort in that early investment.
I'll add very quickly. We didn't really talk about this, but the sidecars, I think, are very important because as due diligence teams, we're involved in making recommendations to the membership. But it's very telling when members of the due diligence team then choose to put additional sidecar investments into the companies that they have recommended to the general membership. And in many cases, you will see that kind of support as you did with Convey, as you did with other companies as well. It's not always available, but when it is, it shows you that extra level that the due diligence team felt comfortable that they're putting in their own money in addition to the funds.
Just one final, just to echo what Clay was saying. One of the things we saw in the leadership team, they were experienced entrepreneurs. They were data-oriented, and they had a learning culture in the organization. And so the fact that they didn't yet have a specific entry segment with traction at the point of the diligence would normally be a concern for diligence, but in this case, it was attenuated because we have confidence that the company was going to iterate until they found something, which seems to be what's happening.
Terrific. Well, I'm going to ask everyone to join me in thanking Alan, Michal, and Clay. And then we might have the second panel up. All right, well, Laura, we'll start with you and ask you to introduce yourself to the group.
Laura Bennett, I'm the co-founder and ex-CEO of Gerace Pet Insurance, which we founded back, well, we arrived in Cleveland back in 2004, sold our first policy 2006, and I exited it last year in August.
I'm Dan Rose. I'm a 30-year entrepreneur, have 4 different companies, started, grown, exited. Been a North Coast member for maybe 8 years now, I suppose that. Involved with a couple of the funds, also involved with Alpine Capital, and I teach down at Ohio State the I-Core lean launch methodology, which is what the last panel was talking about that Sam was using for doing his discovery, which I highly recommend, and I'm an advocate. And lastly, I am a consultant with EOS, which is the Entrepreneurial Operating System. I was drawn to that in part because I will not invest in the future unless companies have an existing operating system, and I was drawn to EOS.
I am Stephen McHale. My history is co-founder, chairman, CEO of Explorus, and that was an IBM acquisition. We had spun some intellectual property out of the Cleveland Clinic and then built a big data analytics company. And now I'm a partner, one of the directors of a new project called the Unify Project. So we'll, at some point, we're going to hear some more about that. And I'm going to stand during this because I'm going through some back rehab, and I'm much better off from standing, so I don't know why I look weird standing. That's why.
Well, thank you. Well, Laura, we'll start with you and harken back to the CB Insights funnel again. So you told a little bit of your story where you dove in the top of that funnel, raised a couple different rounds, and popped out on the right side with an exit. So we'll ask you, what does it take, characteristic-wise, skill-wise, talent-wise, for an individual to successfully navigate that as a CEO?
I was trying to think of what to say, but I thought, frankly, it's a complete disbelief in the whole funnel. You would never do it if you actually did the math. I mean, I'm an actuary. I mean, if I actually believed it, I wouldn't have done it in the first place. You have to have a complete belief in yourself, and that you would be able to navigate, and that you would do whatever it takes to get through each step to be able to convince, the next round to happen, to pivot the company, to lay off people, whatever it was going to take, you would do that. So there's sort of a determination and doggedness and an end goal. The end goal has to always be there. And so the type of CEO that will put the survival of the company and the shareholders above all else is kind of, I think, where you have to go. Ideally, of course, you can bring the whole team along with you to make that happen as you go through.
Next question for Steve. As you're talking to an entrepreneur, again, having navigated that funnel successfully, are you primarily evaluating their ability to successfully hit the first or second milestone, or are you evaluating them in the context of, does this person and their team have what it takes to take us to exit?
Well, at least from my perspective, we've done other financings. I run a small group called 23 Bell. So what I look for is understanding the continuum and seeing if there's a break point and looking for that, that insight as to when you're thinking that someone's either topped out or ready to go to the next level with some support, with some training, with maybe some insight from a group of advisors that can surround she or he through that process. So it's pretty hard, I think, initially to define whether or not right from the gate, whether you've got the right person to take it all the way out. You can, we do deep profiling, we do, legitimate one that's a board, that, from a behavioral characteristic standpoint. And so we have a pretty good feel that at least they're going to get you going, and, we got a good shot at it. So again, some of the traits we heard earlier, like curiosity, input, the ability to be coached, tenacity, grit, as Laura said, look for those kinds of things, tough-mindedness, and just openness and directness. So we get right into very deep behavioral interviewing and make sure that we've got an idea of where we start. And then we think about, well, where would you invest in the individual, because that's always our number one option, is to really get them follow the goal.
Yeah, so Dan, the earlier you contemplate investing, the more important the CEO and the team is, because that's primarily what's there to evaluate. So as you hear these various characteristics, what stands out to you as most important, just in your personal decision making that you're looking for in a founder?
So when you gave the presentation earlier, Todd, and you were sharing one of the slides and talking about the 5 or 6 companies that had these inflection points, you said the goal of these companies is to sell something. And that's it. That's the goal for all of us. So the ability to sell is number one characteristic for me. There may be some 1As, but if they can't sell, it's a red flag for me. It doesn't mean that companies aren't started with strong engineers and strong tech and strong innovation, but they better have a really strong salesperson who's in the sidecar with them that has proper motivation for them. So I think ability to sell is second to none. I think the ability to articulate the vision, where that individual sees the company going, to all constituents that are involved, whether it's their customer base, whether it's the staff, whether it's the investor base, where is the company's vision, and lead me there. Set the tone for the culture. Be one of the pillars, the foundational components of the culture that's there, because culture will help you get across the goal line more than anything. The adage is culture eats strategy for lunch, and it's true. So that ability to convey and communicate, how about that, Sam? How about that? $10 right there. The ability to communicate that vision is just critical. And then I think just the willingness to listen. We've heard that from some of the other panelists, the willingness to be coachable and to take advice, to recognize where they're weak, to recognize that you need people that are stronger, better than you, and the willingness to embrace them and to give up some of the control. It's really difficult early on for some of the entrepreneurs to do that, but it's important.
And I'm going to go off topic a little bit back to Steve, because the last couple answers have been interesting in talking. A lot of early stage investors talk about coachability, right? They want people who are coachable. And in many ways that implies they're working with someone who doesn't know what to do, right? And in reality, we only invest in people we think are highly, highly competent. We hope they're open to our ideas and that they're open to perhaps more than listening to us, listening to the market, listening to their customers. But how do you find that balance when evaluating a CEO, the extent to which they are 100% confident they're going to run through that wall and just be successful, versus stepping back, listening to the market, and maybe making some changes? Because I feel like the media will glorify oftentimes those CEOs who just don't take no for an answer, and that seems like a small minority. So how do you balance that?
There's no just black and white answer to it, but I'd say that it's when we evaluate a person's ability to listen, your ability to deliver the message and the input. So we get pretty deep into the social interaction and the behavioral part of it. And so, I always say, let them run, let them go. But then you're just kind of around and tapping here and there and then offering some insight so that you don't sweep their legs. And it's really one of our core values that we operate under, which is empowerment. And we just basically stick to it because, what do you need that leader for if you're grabbing the wheel all the time? And that, along with accountability and great ethics, is a good formula, we think, to center a business on culture. Dan said, I once again couldn't agree more that culture eats strategy. And almost, what people would consider brilliance. And we just have some real experience around that. Culture, when you bring all that power together and you wind it up, it just becomes like a very powerful flywheel.
So Laura, you, again, were successful in your business. You mentioned you were an actuary. So in addition to having the skill set to be successful as an early stage CEO, and many people here would look at that and say, you can run any company and be successful, right? You had specific domain expertise around a critical aspect of your company. How important is that? How do you look at the trade-off between having somebody who knows how to fly a plane, right, and they've proven they can be a successful CEO, versus perhaps someone who has real relevant domain expertise, but not the CEO experience?
It's a good question because, you know, if I was to look at, say, just all the pet insurance companies, I mean, the one that's the publicly traded company, he was a cigar salesman, and he can sell. I mean, when I'm looking, you know, I'm an angel investor as well, and I look at companies, I do want to see someone that's got some unique insight into that market, and because I likely am not going to have that as the same level of insight as they do. I think, you know, I wasn't a CEO until I was one. So that you develop over time, and I had great mentors and an awful lot of support to help on that, and I think that's something that as long as you have the characteristics that you can get there, I think the market knowledge is really, really key. So I would say yes, you have to know, so you know, you would need to, not everyone can just be a CEO without knowing anything in that area.
So we'll just do two questions that are free for all, whoever wants to grab them. Is there such thing, or do you subscribe to a minimum viable team? Right, for you to evaluate a company and want to consider investing, do you need to see a certain number of people, a certain set of capabilities? Could you invest in a one-person show with a vision for how to grow?
I'm going to beg, borrow, steal from the approach that Sam had taken, which is really the lean launch methodology and starting a company, whether it's one person or 100 seed stage. What Sam did, to reiterate, was he did discovery interviews with the marketplace, and he was raising a hypothesis. I think Convey will do X. I think it's of value because of Y. I think it's better than what's existing in the marketplace because of Z. Would you be willing to pay A for it? In what circumstances could we make it better for you? What features or functionality? He's doing this without building the product itself necessarily, or maybe it's a very minimum viable product. So that approach resonates with me, whether it's one individual you're investing in or 100. I know the next panel is talking about product market fit, and that's critically important. I think it was 41% from your CBI stats here that said, in effect, you don't have product market fit, that's why you're failing. You can stack the deck by doing successful, appropriate type of discovery, and 100 is sort of a magic number before you actually launch, before you're putting a great deal of money into it. And guess what? You pivot multiple times along the way. So what you started with may be quite a bit different from what you ended up with and what you find investors were attracted to.
So one more we'll toss up, then we'll get a couple questions from the crowd. So we saw the picture of the 4 CEOs. 3 of them founded their companies before most people in this country knew what the word internet meant. So how do you check yourself against the biases of making decisions based on what worked 20 years ago, your perception of what is successful, our perception of who can be successful? How do you do that so we don't miss great opportunities?
Well, you know, it's just from the last panel with Michal, I think you made a comment that that was great, which was don't walk in the door flipping out the buzzwords, blockchain, machine learning, go down the list, right? And I think that's really important. I think it's also when you think about even economic development, for example, and this big buzzword around blockchain, and we're all, hey, be the epicenter of blockchain. And I think that what those individuals did was the Einstein level thing. They were really seeing around corners, right? They were out in front of it. And I think even the economy can do that. But you just got to sit down and say, okay, let's not just read the press and see what's going on and show up with buzzwords and just all that stuff. Because you just, you're just going to be a me too. And so I do think that, even though those look like anomalies, they're real. And an individual can do it, and so can a whole market and economy. I really think that potential's there, and Cleveland's got a shot at it.
Questions from the audience? So I saw Jen first. Laura Steiner. Laura.
So I had a question wanted to know is what part of the due diligence process involves questions from the entrepreneur, and what might be the biggest lesson North Coast has learned from how the entrepreneur engages North Coast in their evaluation of a potential investor.
So,
There.
oh, sure. I think part of that is seeing what the entrepreneur is looking for through that process. So even though we're the ones, right, we're dating in both directions, we're looking at them, but they're also looking at us. And by that I mean, what are they looking for from their investors? So angel investors come in many flavors, and Todd has a slide that didn't show that shows in different flavors, and even the panel up here, from their own experience, are each going to ask a different question of the entrepreneur. But the question I think you're asking is what happens in reverse? And I think in that case is what does the entrepreneur want from his or her investors? Does he or she want coachability? Some don't. They don't want the advisors. They think they have a good understanding. Some, and one we had that we went around a lot, and that was the issue of compensation. That is a big issue of how entrepreneurs are compensated at the early stage. You want them to have enough money where they can eat, they can take care of their family, but you also want them to spend your money wisely. You're giving them money. You don't want to see your full round being invested in your salaries. So that is a back and forth that's going to occur. And a lot of that is the questions they are asking you. We had another case where there was a consulting, he was doing very well consulting, and we actually realized through the due diligence that he was better off continuing in a consulting mode and not going into a seed or an entrepreneurship environment. So when they start to ask us questions, we also help them identify what it is they want for their company, and are they really interested in getting investors? I hope that answered your question, at least part of it.
I might just say, as we've looked at what entrepreneurs are most successful in managing a diligence process and what that says about them, I think it's those CEOs that treat us exactly like customers, meaning there's a little bit of difference, but they're also experts in what they do. They don't deviate from the vision of what they don't conform their story or their product to what we think we need to see. They follow up. If we forget to reach out, they reach back kindly, but remind us. And they also manage expectations, just like you would any pipeline, right? Because at the end of the day, if you're raising money, it's a sales pipeline. You need a lot of candidates in your pipeline. You're going to qualify, progress people through. And it's not the idea of treating us in a way that makes us feel special. It's treating us in a way that makes us realize that's how you're treating your customers. You're going to be really effective in selling your customers and in raising follow-on capital because you're doing it in a way that is assertive, constructive, direct, and is likely to be successful. John?
What's the best way to evaluate the team? Because that's a critical part of increasing the due diligence batting average, hopefully from 10% to higher. What method do you find best? And I'll give an example. We have a partner that came into California with his team, and we spent 2 days, including a dinner. And that's a critical part of his method of evaluating a team. In our case, it was us. But, how do you recommend evaluating a team?
Right, and I'll go a little fast. One of the things that we started with a macro version called Strength Finders. And once you're a team, so you're not doing that as a screening to employment, which is not what we're allowed to do. But then we also, like for our team, we're doing VIA, which is a 24 strength, and it's got the signature strengths, your top strengths. And even though you may see a high tilt one way, like on curiosity, things like that, competitiveness, things like that, doesn't mean you need to pivot that team and redesign it. It just means you better know what those strengths are, and then start to look at what you need to complement. You need better operators and leadership and that sort of thing. But that's how I look. The most important thing I look for is behavior, the characteristics, the combination. What's the environment like when it gets tough? Because it will. Will that team stay together? Will they be tough-minded? Will they plow through the issues and work collaboratively? And I think that's my approach.
I would add just really quickly that I think core values are critical here. So that's certainly related to what Steve was saying, but core values, to try to vet those in a matter of 1 or 2 meetings is really difficult, but I think you can do it. There are a handful of questions that you can probe and ask and get to the meat of someone's sort of true id pretty quickly. And if they don't align with your own personal values, I think those are deal breakers. In my experience, I've made bad decisions when someone is extraordinarily talented on paper or they have a history of high achievement, but the means in which they attain that achievement, which I didn't know at the time were sketchy, that's really a problem for me. So I think those core values are really important. One real quick question that you can ask across a table, tell me about your biggest learning experiences that have nothing to do with your school education or business. What you're really doing is getting to core sort of formative experiences that those individuals had, and how vulnerable are they going to be with you? How honest and open are they going to be, right? We've all made mistakes. I want to hear about theirs. I want to know how real they are and how much they'll open up with me. And I make gut instinct sort of decisions as much as I do on hardcore data the older that I get, and it served me really well.
Clay, did you comment?
I just wanted to ask the group if I could. We tend to look at the management teams in a bit of a static way. Here's what you've got coming out of the gate, and you're sort of thinking of that team as the team that's going to carry you forward to success. But there are a lot of schools of thought about you need a certain kind of expertise to get a company launched. It may be very technical in nature. And then you need a different kind of expertise to grow an organization and understand how to build a culture and how to really get momentum. And then you get to a bigger size and the organization's complex. How do you think about the evolution of the management team as you look at the companies to start with, and then what do you do with that evolutionary thinking later on?
I can just give the example of me running a company and going in and saying, I expect that at some point I won't be the person running this. I have technical expertise, but I don't want to be just that. I actually do want to grow as a leader, so I would like to take it beyond that. But as for being in for the fully long term, then that's probably not going to be me. Plus, besides, there was 2 of us. It can't be 2 of us going forward with this, so we will augment and bring people in along the way, being aware of what it is that we need. You become very much more operational at a certain point, so bringing in operational strengths. There's so many different areas. So it's dynamic, and there might be one core person that keeps that culture and pulls that through, but that team has to expect that it will change along the way, and it might not be them. Probably won't.
Yeah. I get to offer one comment. Just for me, I knew when I was getting my edge, and I was clear with our investors, and I was clear with the acquirer that, high scale operations is not my thing. I can get through the first 2 things, Clay, that you mentioned: build the culture, scale it, get it going, get the core thing, get it operating, get it so the engine's running. But I got to a point to where I was real clear. So when we even did our agreement with IBM, I was very clear. I said, hey, I'll stay around for a little while to make the ease and the transition. It doesn't have to have a time specific to it, whatever's appropriate, but be clear I'm not going to take some operating role. I'm just being upfront, that's not my wheelhouse.
Well, thank you very much.
Todd, I'd be remiss if I didn't recognize my bride of 31 years today, Carolyn, who's with me. So we're going to sneak out the back. If we get our name drawn for the Angels entry, don't tell me. But,
I want to be in the drawing too. I got to run.
Yeah.
Sounds good.
Thanks.
Thank you and congratulations. As we invite our next panel up, I'll just mention one thing, and
Steve, you may remember this, but when we were on an early diligence project, probably 8 years ago, you had started to talk an entrepreneur through a thought process. And the first question you asked wasn't about the company, it wasn't about him, his education. You said, who was your favorite roommate?
Right.
And he looked at you like he was gonna fall out of his chair, right? And it wasn't a trick question, it wasn't an unfair question, but clearly you just wanted to hear this person talk a little bit about himself. And then after he told you who his favorite roommate was, he said, what did you really like about him? Because he didn't really get there. And said, what else? And you talked about, I think, was there any roommates that you didn't care for?
That's the one that you get.
And then you saw this kind of crap moment, right? It was changing. And at the end of the day, it's a little sneaky, but I really appreciated that. And I was probably quieter for longer than I've been in a long time because I was just enjoying going down that path, but I felt like I learned more about that CEO than I would have learned with the simple, predictable questions that I would have brought to the table.
That's it. Look for conflict in the worst roommate in college. And how they handle conflict. It's one of our questions. Yep. Dan had good ones too. So
Great.
Yeah, thanks.
Well, thank you. And we'll ask this panel to introduce themselves, starting with Connie.
Hi, I'm Connie Weisman. I'm VP of Corporate Partnerships at Plug and Play Tech Center.
I'm Sam Gerace. I'm the CEO of Convey, which you know a fair amount about because it's been an exemplar tonight. So it's company number 5 for me. I've started, grown, and sold or taken public before this. And my training originally is as a biochemist.
And my name is Scott Flamm. I'm a physician at the Cleveland Clinic, and I run a group of docs who do CAT scans and MRIs of the heart primarily. And I'm a member of North Coast 2 and 3 in the Venture Fund, and really delighted to be here tonight with all of you.
So Connie, we'll start with you. Can you give us a bit of a high-level commercial for what Plug and Play does as it relates to validating technologies with your corporate partners?
Great. Well, first of all, we're thrilled to be here now at Cleveland. So we just opened up Plug and Play in Cleveland. I think we launched on March 1st. So our 2 founding partners are Cleveland Clinic and Jumpstart. So we're thrilled to have them as partners and probably be adding up about 4 or 5 more by the end of June. So we're in contract with a few others. But how we validate technology, we have a very unique approach. We have created an innovation platform where we have 300 corporations along 14 industry verticals. So think about your Fortune 500 companies that are looking for an external pipeline of innovation. So things that are not being created internally, but they're looking for what is potentially being created outside my 4 walls that could enhance or potentially disrupt what we're doing. So what we did was we created a platform. We've been now in business since 2006, and I say like in dog years, we're like 77 years old, like we're so old compared to any other accelerator, and we are kind of shying away from the word accelerator too. So we call ourselves an innovation platform, and about 5 years ago we went full strength on corporate members. So that means that corporations join Plug and Play, and they tell us what their technology interests are. Then we source startup companies, and we put the startup companies in front of them in a very curated, vetted way. So this gives us a lot of opportunity to see the startups, to see if the corporations like the startups. So that becomes very, very valuable information for us to invest on. Because if we see 5 predictive analytics companies, how do we know which one's the best one? So what we did was we decided to go to the experts, and we go to our corporate partners in those industry areas, and we ask them, hey, we see that you're interested in predictive analytics. We're going to bring in these companies, and then we see which ones get the pilots. And if they get the pilots, then we know, okay, that's the one to bet on. So for instance, we had a company that came from Columbus, Ohio, drove out to Silicon Valley. It's a company called Previdere. And we were just starting this corporate partnership, and we put them in our retail and brand accelerator. So that was about everything about the customer's path to purchase, the consumer's path to purchase. And we put him in front of Anheuser-Busch, and we put him in front of lots of other retailers, and he got 14 pilots. That was very easy for us to decide that we were going to make an investment in his company. So I think we have a little bit of an unfair advantage. I know our venture capital friends are not thrilled with that. They're like, oh wow, we want to get in on what you guys are doing because we have such a great validation process. So that's in essence how we're working.
Great. And Scott, when Daniel was talking through the North Coast process, he laid out some criteria which would help to define what we're looking for in terms of product market fit and where a product and offering needs to be. As an individual investor though, do you have a materially different set of criteria you were looking for?
I think I would say that as a broad brushstroke, certainly the approaches that we take in North Coast are a great starting point and really solid base of things that we're looking for. But as an individual angel investor, I would say probably not terribly different. I would say that it changes when I become a sidecar investor. And if that wasn't explained before, the sidecar is when, for the North Coast Fund, I'm a member of the North Coast Fund and will put money into the fund itself, and the fund invests in a company or an entrepreneur. But as a sidecar investor, I would write my own check that is separate from the North Coast Angel Fund's check. As a sidecar investor, I may look a little bit differently, and then I'll look a little bit more closely, and I will tend to go with areas that I have a particular affinity for or understanding of, or am really just overwhelmed by the CEO entrepreneur. And since this is a convey, Sam Gerace, Love Fest, you can all write your sidecar checks for Sam. So I would say to a small degree, but not a great degree.
Great. Todd, can I say one thing about sidecars? Right. So from the company side, we've got 5 NCAP members who are sidecar investors, and each one of them has contributed in ways beyond their money already, and we've got a relatively short duration on that investment, just a couple months. Right, so they've come to the table, they've brought their specific expertise, they've helped us thinking strategically, they've introduced us to potential customers, to potential investors, they've helped us refine certain approaches. So, it turns out that those sidecar investors have a great deal of value beyond money if they do what Scott says, if they're thinking about those investments where they have particular subject matter expertise and can bring it to bear.
So, Sam, as Alan mentioned before, market timing is a big piece of this, right? Are there necessary conditions, whether structural or social, for a company to be successful? Is it the right time? Is it too early, too late? How do you think about timing? Not only is the timing generally right for this type of offering, but is it timing that this team can actually take advantage of and be successful?
Yeah, so how many of you have ever been on a surfboard? Right, there you go, all right. So, right, entrepreneurship is like surfing. You can be a great surfer, you can have the best board, it can be all waxed, and you can be on the water. No wave, no surf. And there's nothing you can do to create the wave. And I think most entrepreneurs forget that, right? We're busy understanding we've got a great team, we've got a great opportunity, but Todd, what I'm looking for and what I try and build a team to do is do waves fine. Because paddle as hard as you can't create the wave. So we identify an opportunity space, Alan talked about that, we see an opportunity space. I want to know that there are several major market forces pushing the market toward that space. So in the case of Convey, we're device-based, but we're delivering enterprise value with devices. And by the way, the Convey idea has been around for several years, and the reason our first patent was granted is we filed IP 2 years ago. We didn't devote $1 past the IP until I saw 3 major market forces begin to come to bear. Number one, last summer, Apple and Google released enterprise development toolkits. The prior 10 years, they've been busy focusing on consumers. So that said, devices would begin to enter the enterprise en masse. Number two, enterprises got off their passive-aggressive stance toward bring your own device. some of you are old enough to remember when we all issued computers and phones to everybody and had to carry two, because you weren't supposed to keep your personal information on the company computer, vice versa. And since that proved no longer viable, companies have had this passive-aggressive stance. We'll just ignore the device. They're not doing that anymore. And that's market force number two. Companies have finally said, we will have to find a way to embrace the device, even though it contains both personal and company information. The last thing, and Dan Rose mentioned it, is, and Steve Blank said it pretty eloquently, if we can see that potential customers are trying to cobble together their own solutions to get to that opportunity space, then I know it's time for a mass market solution. So that's why we went out and did an initial set of interviews. And by the way, now that we're a little farther in, we've now done over 400 interviews. And we're continually doing it, right? We're adding 50 to 70 a month. We want to hear that people are still trying to cobble together their own solutions to get into that opportunity space. Because that means when I deliver mine, and they don't have to cobble it together, they'll buy it.
So, Connie, for you, when you're looking at these kinds of opportunities, so a great example of putting a company like Prevadary in front of these prospects and seeing who buys. But the old adage, right, is that if you ask somebody, if Henry Ford asked someone what they wanted, they say a faster horse, not a car, right? So oftentimes buyers don't know what they need necessarily. They don't know what's available, and sometimes you can have the problem of talking to a couple people who really are innovators and are early adopters, but the rest of the market isn't going to be there. So can you give us a little more insight to how you try to sort out bad signals that you might get from some of these companies who, for reasons unbeknownst to us, might be sending mixed messages or ultimately not be indicative of that larger market wave?
Because we're dealing with corporations, mostly, they really do know what their pain points are. So it's no big surprise. Typically in healthcare, we have population health management, workflow, sensors keeping people healthy. I mean, we have the corporations sitting shoulder to shoulder with each other, and we see the same problem. So I always feel that the entrepreneur that does the best is a serial entrepreneur. I would definitely bet on someone who's done it before, has seen the movie, they know how the movie ends, it ended well, we're going to bet on that person again. That's like a no-brainer. The second best thing is to find someone who's actually experienced that pain point themselves, and they're trying to solve it. They're not just coming out with some idea that has no relevance to something. It really is, again, I want to go back to Prevadary only because he experienced this problem himself and predictive forecasting. And because he cobbled the solution together, he was able to say, hey, I experienced this. I want to bring this to you. I know other markets are experiencing the same thing, so let me bring this out. And that's when Anheuser-Busch gave him the pilot. He wound up saving them $9 million, and when they should forecast purchasing aluminum. So, that's very easy in terms of, how to look at product market fit and how to evaluate if you're just looking at some early adopters. We're not looking just for consumer, we're looking for enterprise, like these enterprises are buying into these solutions. That's very, very validating. And the other thing is that I wanted to mention is, we keep going back to, team, and I told you that, and this has come up a lot tonight. That's probably one of your first indications of if you want to invest. It's like the people. You're investing in the people right away. I mean, a lot of the companies we invest in are pre-revenue, so it's not like we have this, great history. And Saeed, who is our founder, it is a family fund that invests. We make about 160 investments a year. So we put a lot of small bets on a lot of things. And some of his early investments were Dropbox. And I'll tell you, he met Dropbox, he met the two founders at a kebab party. So this is not like not a ton of due diligence. But what happens is he sees that the venture people in that industry were interested. I mean, so Lending Club is another story that he talks about. Are you guys familiar with Lending Club, the peer-to-peer lending platform? Renaud Laplanche walks into Plug and Play in 2006, and he has this idea for peer-to-peer lending, which just sounds like outrageous, right? Like, that doesn't sound like that's going to ever happen with SEC regulations and banking and so on. He invites them to meet Jeff Crow of Norwest Ventures, which is Wells Fargo's, venture arm. Well, he immediately loves this idea, and this again becomes validation for us to invest on. So it's almost like we call it collaborative due diligence. So that means like all the smart people in those areas, when we introduce that technology, we see what the attitude is about that, and that becomes information for us to invest on.
Great. And Sam, so we heard about your process of dialing, talking to, getting feedback from 100 plus customers. When the shoe's on the other foot though, and you're the investor, how much time and energy do you think it makes sense to put in to call current customers, prospects, people within your own network to have independent validation of that market need?
Yeah, I think that's critical. That's the legwork, and if you're willing, I see a lot of investors who are willing to do that legwork who benefit because of it, and investors who don't to their own detriment. We can all be seduced by really appealing idea. And especially if it's not right in my area of subject matter expertise, I don't appreciate the friction points in the business process that are going to cause an enterprise not to buy it, or that are going to get between the product and the ROI it's supposed to generate. And so the aspect of due diligence that is probably the hardest is getting through to someone who is a pilot user, who could be a pilot user, who's a potential customer, and getting them to have a real discussion with you about the ROI points. But as an angel investor, that's probably the highest value activity beyond the assessment of the team that I could engage in.
And Scott, a question for you on establishing market opportunities for life science companies. We've primarily talked about companies selling things, and most companies are free to sell things. These life science companies are encumbered though by the FDA from a regulatory perspective, CMS from a reimbursement perspective, the actual health payers from will they pay for this, and then ultimately physicians to prescribe. So how do you think about market traction, market opportunity, and what you need to see in order to feel like an opportunity is real?
I think, well, is this a comparison to something else or simply on its own?
On its own.
The reason I ask that question is that the life science category is fairly broad. I mean, we might talk about something like a Fitbit, which is a life science category of sorts, but that can be a piece of software that can be used in a lot of different ways and can be very similar to many of the other apps that you have. Or we could be looking at a biopharmaceutical. And we tend not to look at those as angel investors because the time scale, the timeline to get to market is so long. Unless you've got something that's very specific, that's got a pretty short timeline, and then I could look at that. In our realm, we tend to look at more software or diagnostics or occasionally devices for the life science areas. And those have short enough timelines that we can get involved and have an understanding of how much traction can occur. And part of this is getting and talking to those potential customers, depending on what the particular device is or diagnostic, and really having those conversations with the potential customers would be a much better idea of whether there's really a market there. And I say this, I think about Michal a little bit before talking about it being a bit of a dating game. And I have a very clear, vivid memory of one of the CEOs that we spoke to a few years ago. And I will tell you, don't tell my bride, but I was gaga over this CEO. Just fell in love, head over heels. Mature, knowledgeable, sober, credible, sort of everything. Absolutely fantastic. Well, until we met Sam, of course, because it's never going to end tonight, so I'm sorry. Which is absolutely fantastic, and think, boy, this is going to be great, this is fantastic. And then we get and talk to the customers and say, gee, it's a great product. It's really pretty wonderful. But it's only a little bit better than what we already have. And gosh, the barriers to overcome, no, it's just not worth it for us to change. You know, and those interviews with those potential customers were the most critical aspect. Because if we had just sat back on our heels and said, well, look at the CEO, look at this team, and look at this product, we would have just dove right in. Right? That's just part of the process.
Okay. So last question for Sam, then we'll take a couple from the audience, and I think you tee this up well, Scott. So as far as competition goes, everyone is competitors, and you're looking for opportunities that are differentiated, right? Why they win, why this particular company wins. And I think even as Connie characterized it, it was clear that, geez, if you can find 5 of these in your backyard and put them in front of a company, there must be hundreds for every major problem, right? So how do you get comfortable that there's enough differentiation of the actual value proposition in order to make a bet on an opportunity?
Yeah, and that, let me repeat what Todd just said with slightly different words. Is there enough ROI differentiation for customers? That's what matters, right? You got products that are prettier, you got products that have more colors, that have a few more features. The question is, can a customer quickly see that there's an ROI differentiation in their purchase of your product versus another one? I think that's the absolute most critical evaluation to do at the early stage. The answer may be that I can't really tell, but what you don't want as an angel investor is to have 5 competitive products out there and yours not be the one that has a materially better ROI for the client. And that can be a little difficult, right? I mean, look, if I've got a new solution to ablate the heart muscle to stop atrial fibrillation and it reduces in the lab readmittances by 10%, there's a fairly simple equation I can run to look at that ROI. But if you're in other space, like Convey, you know, we have different propositions for independent retail, chain retail, small and medium business, and enterprise. The ROI return gets greater and greater, but the enterprise integration is deeper and deeper. And so we had to go fairly deep early on to convince ourselves that we had a better ROI proposition than things that they don't necessarily look like Convey, but they could be substitutes. And the question is somebody going to look at that and say, yeah, that's an effective substitute, or are they going to say, oh, there's no way it could match the ROI? And I, as a founder, I have to be careful not to fall in love with my own product, right? I have to say, what does the customer think in terms of ROI? And so I think, Todd, I would say to anybody who's angel investing, the differentiation has to be expressed by the client, by the customer or potential customer in terms of ROI.
I think we're going to take one question from the group here, and Mike Hammer has a fast hand. Then we will be on to the last panel and the drawing for Angels Envy.
So I wasn't, Mike Hammer, I wasn't sure which panel to ask this question of, but market opportunities, how could I exist? So Masayoshi Son, with his Vision Fund, is shaking up the VC end of the investing spectrum. And he's kind of changing the value proposition for evaluating market opportunities. Do you see that impacting the angel end of the spectrum? Well, that kills the conversation. So, okay, his first Vision Fund, he raised $100 billion, and he's actually going to founders who have approached him, or he's reaching out, and he's basically forcing them to take multiples of the amount that they're asking for, and saying, if you don't take my money, I'll go to your competitors. And so he's raising the spend level, he's raising valuations. This is all happening in the last year. Just in the last day or so, he's announced a second vision fund in 2019. And to give an idea of the scale, I believe that in the US, total VC investments out of Silicon Valley in 2017 was something like $12 billion, something like that. He invested $30 billion in the last year just from his fund. So I'm just curious, if the entry-level investing market, do you see that having impacts? If so, how?
I'll take a quick stab, and not to spare anyone, feel free to pop in. In Cleveland, it feels like we're in a bubble where we're not impacted by some of the major developments coastally. That may or may not be true, but that's what it feels like. A lot of these large funds, and a lot of them with international sovereign wealth money, tend to be displacing late-stage mezz debt, or even bypassing the IPO process, right? Because they're deploying meaningful amounts of money to companies that are at a mature stage. We don't feel that echo. There may be some that do. Most of our companies we anticipate will go through a strategic acquisition anyway. The company of ours that has raised the most is $100 million, a Gerace raise. So that's pretty pedestrian compared to some of these larger deals. We just don't seem to be involved in mega deals where you have, I mean, we recently had General Catalyst invest in a company which Plug and Play also invested in, and they're $1 billion fund. That's more a rarity for us as a smaller investing thesis, as a smaller group here. We tend to have more $200 million funds, so I would almost, not playing dumb, but I feel like we don't get impacted by that very much. Maybe we will more in the future.
The earlier you go in investment, the closer to the investors the investments get, if you plot them, right? So there is, the idea that capital is fungible is true, with the caveat that the earlier stage you go, the less fungible it gets. It gets more viscous and it tends to be invested in close proximity to the office of the investor. And so especially for angel capital, and especially in the Midwest, I suppose that could affect prices. I mean, in the market generally, and that might affect our prices. But I suspect that we are in our own local ecosystem as angel investors because of that sort of characteristic that investors like to be close to the early companies, right? Because they typically provide more than money; they're providing expertise as well.
All right, well, thank you, and we'll invite the last panel up. So Clay, not only do you need no introduction, but you've already given an introduction. So we'll pass it over to Dan.
Hi, my name is Dan McMullen. I'm a partner with Calfee, Halter & Griswold, a regional business law firm here in town. Practice intellectual property law. I chair our firm's information technology practice. Before I studied law, I designed management information systems for General Motors for a few years. I've been a member of North Coast Angel Fund since back at Fund 1. I'm an amateur at this activity. I have the track record to prove it. And, but I've tried to learn from Todd, Clay, and others as we go, and hopefully I'm getting better at it.
I do believe you are one of the investors in North Coast that made a sidecar investment in a Gerace.
That's true. You taught well.
Well done.
Hi, I'm Paul Hamerly. I've been a member of Fund 3 for North Coast Angel Fund for about 15 months. Started my career in corporate life with Heinz and Nestle. In the mid-90s, tried to make an acquisition, made 8 offers to 8 different companies and didn't land one. So started a company out of the basement, hybrid family business with a powerful team called Kitchen Basics Cooking Stocks. It's a cooking product sold through supermarkets in the Tetra Pak box. Built that up over 15 years and sold it to McCormick in 2011. Since then, been doing all kinds of different things, took flying lessons, became certified at the Gestalt Institute for coaching, and I started doing angel investing with the Canton, Ohio Impact Fund. There's about 37 members, a lot smaller than this and a lot less formal than this group. So, honored to be speaking because there's a lot of people in the audience that have a lot more experience than I do.
Well, thank you. We'll start with you, Dan. You mentioned IP, and we haven't talked about that a lot. For the types of companies we invest in at this stage, how important is IP, and how should we angels who are perhaps not adept at reading a full patent application or even understanding the nature of how these protections work, how should we think about them?
Yeah, that's a very good question. Many of us as angel investors recognize intellectual property. Oh yes, that's very important, but it's kind of an arcane topic. Our eyes glaze over, and we tend to default reflexively to the question, well, does the startup company, do they have a patent, or do they have a patent application? And if that's all the further our assessment goes, then we don't know very much. If the answer is yes, we say, okay, that's good, that's valuable, they get a higher score on our matrix. If the answer is no, okay, that's bad, it's riskier, they get a lower score. But the questions that are meaningful to us as investors in making an investment, I think, require us to go beyond that. That question is first of all, too narrow. There are multiple forms of intellectual property beyond patents, copyrights, trademarks, trade secrets that in some instances may be far more valuable to a business enterprise than having a provisional patent application. The yes or no, the check the box reflexive question doesn't include any kind of a qualitative assessment. There are valuable patents and there are worthless patents. And it's hard to get at that. I mean, it's a challenging problem for angel investors, but we should at least be conscious of that reality. One way to get at that, I think, is to, when in the course of due diligence, to ask the entrepreneur or somebody on the management team to articulate how or why intellectual property is meaningful in their business plan. If they can do that, that tells you they've at least thought about it enough, and you can assess that. If the answer is simply, oh yeah, we have a patent application, then maybe they haven't thought about it as much as they should. But one last thing I would say is that simply that check the box question, yes or no, do you have a pending application, ignores the significance of other parties' intellectual property rights and the impact that may have on a business. It's a little bit counterintuitive, and therefore I would say widely misunderstood, that having a patent doesn't necessarily entitle the party to practice the technology or the invention that's covered by the patent. Let me say that again. Owning a patent doesn't entitle one to do what the patent claims. A patent right is the right to exclude others, and that distinction can be meaningful. Now, typically for angel investment, we don't have the opportunity to do full-blown, freedom to operate, freedom of use study, but we should at least be circumspect about what we don't know. A little bit of modesty there goes a long way, I think.
Could I ask a quick question about IP? How often do you see IP in the software arena?
So over the last, I would say over the course of my practice in law, intellectual property protection for software has become a critical aspect of software businesses. Now, it may take the form of patents, and through the late 90s, through the dot-com bubble, and well into the 2000s, patent protection for software was a hot arena, and lots of software patents issued. Many of them were not worth all that much. The pendulum has swung back a little bit, and I think of late, in the last 3, 4, 5 years, in the aftermath of some Supreme Court case law, there's been a greater emphasis on copyright and trade secret protection for software. So intellectual property for software businesses is critical, but that question, do you have a patent application, misses the boat to a great extent.
So Paul, a question for you, and even though you're a member of 2 different angel groups, thinking about this more as an individual investor, how formal or structured are you as you're evaluating companies? Meaning, do you have a roadmap? Do you provide a roadmap to the CEO you're working with? Or is it more of a from the hip, topic to topic, get comfortable in a general approach?
I tend to be really informal. There is one thing I've learned to do over the years. I have a certain framework that I look at the flow of the company. So there's 2 general flows. There's inside out, where you start with, here's the technology, where does it fit? And then the other is outside in, which is here's a real market need. What does our company need to do to meet that market need? So the first thing I do when I hear a pitch is I look at whether they're inside out or whether they're outside in. And there's no right answer. There's companies that are successful both ways. But I want to hear the founder's story. Did they start inside out or outside in? And then what I want to do is I want to assess the second of the two. So if they're inside out, if they have a technology that says we're doing this, we have this technology, it's unique, and we're applying it here, then I really want to look hard at how much they're studying the market and getting to know and validate through pilots and questionnaires and things like that. Or the reverse is true. If it's an outside in where they know exactly what the market need is and where the pain point is, are they willing to do anything necessary to reconfigure their technology to meet the need? And I want to see that story change. I don't want to just hear the original story and be in the second year and that story hasn't changed. It should have changed to some degree, and it should continue to change. And so that's one thing that I use as a framework that's a little different, I think, than some other angel investors.
So, question for Dan, just to build on this. So you've got all these different individual angel investors running around doing their own thing, right? You've got groups like us, you've got family offices. So as an individual angel, how do you decide what to trust, what to build off on, versus ask the entrepreneur to come up with the same information, ask the same questions that everyone else has asked?
You know, given the realities of limited time and resources that any of us are able to expend, I mean, it's one of the great things about an organization like the North Coast Angel Fund, or somebody that has, an individual who has an interest but doesn't have the bandwidth to invest the time and energy that it would really require to make an even modestly informed investment decision. I think we have to rely on all the resources available for information, including, as appropriate, co-investors, other offices who are willing to share that information. Certainly it's been true with North Coast over time. We co-invest with other groups, and to me, having the benefit of whatever intelligence they're willing to share based on their own evaluations, you know, I think is invaluable. Like any other source of information, we take it with a grain of salt. We recognize, you know, where it's coming from and what biases may inform it. But, you know, 24 hours a day isn't enough time to do all the proofing that might otherwise be necessary. So I think that's a very important resource.
So Clay, you will know that of the 3,000 companies that we've looked at, not a single one has hit their initial projections, right? Even those companies have gone on to be highly successful. So because they tend to be aspirational and more of a novel versus a nonfiction work, how much time and energy do you spend even thinking about those numbers that the entrepreneur has produced early on before they're really out into the market?
Well, one of the companies that Todd had on the chart early on, it was fascinating. We actually went back and did a plot of their original forecast and then each subsequent annual forecast. And each one was absolutely identical. They were just moved one more year down the line. And guess what? They did that for 7 years straight. You know, I think you learn a lot as you, but you have to be willing to sort of dig into the details a bit. And this could be a time issue as you're talking. I think that looking at a forecast and understanding how the company is thinking about allocation of resources, for example. Earlier on, Dan Rose talked about the importance of selling. Well, in the organization, how much of the resources have actually been committed to that function? It's amazing how many companies you'll find actually have the assumption is the CEO is going to be the main salesperson. And very often they're the wrong person to be selling. And so as you dig into the forecasts and look at those allocation of resources, you can really begin to test the legitimacy of the forecast. I think that something as basic as the reasonableness of margins.
whether it's at the gross margin level or at the operating margin level. Just having looked at enough of these over time, you realize that when certain numbers are projected, they're just not believable. And if you don't challenge the entrepreneur on that, they're just going to run with it, and they're going to end up disappointing everybody. Just think of a few other things. Just underlying assumptions for the business. How quickly you're going to get traction, and have they really, I mentioned this earlier, thought through the resources that are going to be needed, the runway, the money that they have in hand, or the money that they're going to raise down the road. Have they really thought through how long those resources are going to be available? And I think it's a hard process, but it's one where we have to bring a lot of discipline and not just rely on the numbers that the CEO has put out on the table for us.
So lightning round down the line. Do you sign NDAs as part of your diligence with an entrepreneur?
Not if I can avoid it, and sometimes I'll offer to represent them so I can assure them that attorney-client privilege will protect them.
Never. We see too many companies and have to have the flexibility to be able to look at all of the companies that come to us. And I basically say to the entrepreneur, if there is something about your business that you don't want us to know, we might be able to handle that in a one-off situation, but during the majority of the due diligence process, don't tell us anything that we can't share openly amongst all of our members, because that's how our decision-making takes place.
As a member of North Coast and the Impact Angel Fund in Canton, I never sign an NDA. As an individual investor, I always sign an NDA, and I usually ask for one.
Great. So before we turn over to questions from the audience, we'll ask a bit of an absurd question. Hypothetical, you are locked in a room with 3 entrepreneurs. You have a single $25,000 check that you must invest with one of those entrepreneurs. What's the key question or two that you ask to decide which entrepreneur will receive that check?
What's the hardest challenge you've had in your life that you either overcame or could not overcome?
Why do you think it's such a great opportunity, and what are you doing that's different than everybody else?
It's a little too Shark Tank for me, but I guess I would ask, how do you make money?
It's a harder question than it seems sometimes. All right, questions from the audience? Any one last killer insight question?
Yeah, I'm curious for that company example that it took 8 years before the hockey stick kicked off in a sense. Why did you invest in them if you kind of didn't believe from the beginning that, and it really took that many years? I mean, what was kind of the secret sauce that, who these people were crazy and believed it, and they kept telling you the same story, but you kept, drinking the Kool-Aid.
That's a great question. I think the reason we invested in it in the first place was that the entrepreneur brought specific industry experience that we thought might be transferable. I think that the technology was really breakthrough technology, which I would also add today. Believe it or not, it's 9 years later, that technology still seems to be as viable as it was when we first invested. I think that what became apparent to us as time went on was that this was a case where the entrepreneur was not an effective CEO of business. And the success that they're now just beginning to see has not actually been driven by their organization, but by a partner that they brought in. And that partner is really driving the success. So I think it's been a real shortfall of personnel.
Yes?
Paul, on your journey, you're in the food business, I have kitchen basics in my household. How did you get McCormick? How did that happen? You started in your house or your basement. What was the hockey stick for you to get McCormick interested in your product?
You know, when I started the company, I developed a hit list of companies that I wanted to buy us. I call it an exit table, and a lot of people do this. They'll put, here's the companies that are in our industry that buy. And on the A list, I have Campbell's and Hain Celestial, big companies, public companies that were in the soup business because we made soup stock. I actually put McCormick on the B list because they were in the flavor business. So I kind of feel like, I don't know why they were interested other than because they made no soups. They had no liquid products in the world. They didn't pasteurize anything. Ours is ultra pasteurized. So they found it as it was a cooking product and it fit their profile. Campbell's made us an offer and then withdrew it. Hain Celestial made us an offer, but it was very low. So we went, and all three were unsolicited. But I, from day one, planned to sell it to a strategic, and everything we did in the company was for that day. So we ran the company as if we were going to sell it. And I think if you do plan to exit, it's a good idea to have in mind not only who's going to buy you, but why are they going to buy you. And I knew why Campbell's would, I knew why Hain Celestial. McCormick was less certain, but they were on the list. So I don't know if that answers your question. But
It does, and when you started, did you have any investors, or was it all you?
no, Nancy and I put all of it in. We signed our house, and then in 1999, 3 years later, we got 10 angel investors. There was nothing like North Coast at the time, so I had to make 100 pitches to get 10 investors. And the 10 were people largely that I didn't know. The people I really expected to invest didn't. So we went to other people. Thanks, Mike, for that.
Chuck?
Getting back to the 10% batting average we have for our due diligence studies, is the thing Sam talked about something we should have as a minimum, that is including in the due diligence process 50 customer interviews on the product value and price, or maybe we already do that, but the idea of having customer interviews seems to be really might improve our vetting.
Well, there's an assumption that Sam's batting average is going to be the same as the past, but we're counting on that, Sam. I think it would be a terrific idea. I really do think that having that kind of discipline that we share with the entrepreneurs early on. I mean, a lot of our entrepreneurs approach us. They're not necessarily ready for financing. They're thinking about things and maybe preparing themselves for financing. It might be an opportunity for us to say, have you done this? And then incorporate that into our process. I think it would be very difficult. And Sam, I don't know how long the 100 interviews took you to do, but it would be very difficult for us to get that done ourselves within a 3-week period. It just isn't going to happen.
But 10 would be a great improvement over what we do now, in my sense.
Well, we do a lot of customer discussions. I don't think that we necessarily do as broad a number as Sam has done. And I'm not sure that we necessarily apply the discipline that Sam did in taking it to asking about what would you pay for this product,
right?
Which I think is a really important discipline. So I'm sure there's room for improvement, but
I would just add that I think the nature of what we do is very different in that from the CEO's perspective, I think part of the reason they cast such a large net is for ideation purposes and to develop a series of hypotheses that they will then test with other customers. By the time it gets to us, we're really looking to test their hypothesis. So we're not going to develop insights or come up with any of the things that I think that Sam or an entrepreneur would, but our hope is to be able to pressure test the key assumptions and to understand, does this particular value proposition make sense? Is there an ROI for you? Is there a budget? Who would buy it? If you're looking at it, what else would you look at? And just the common sense aspects to see if this is really a problem that looks more like that emergency room situation versus the Band-Aid situation.
Can I just offer that, the best thing is when the company's already in revenue and has customers because it's well beyond that. So to me, the sweet spot of angel investing is an entrepreneur that has been through it before, that's from that industry, has a product, has revenue, has the motivation to stay with it, and the company isn't overvalued. And if it meets those criteria, to me, it's like the bullseye. I look for those rare opportunities that come along that are like that. But earlier, they should have done some type of surveys or something for feedback.
I think it's time for us to give away a bottle of bourbon. So again, we will have 2 drawings. The first will be for the Angels Envy Bourbon. The second will be for the ability to attend this upcoming Cleveland Clinic event where John Doerr will be there. And there'll be a venture capital discussion, and there'll be 2 tickets for the winner. I believe we have here the winner of the Angels Envy, and it is William Sin. I don't know, is Bill here? I don't think, okay. Back in the hopper. The second potential winner is Bruce Terry, who is not here either. Okay. Michael Terry. Is Michael here? Michael's here. All right. And then for the Cleveland Clinic package, Dr. Yang Liu, who I believe was Dr. Pat Hayes' guest, who I do not believe he is here though. Okay, keep going. You're gonna be there already, Connie. Right?
When is it? No, I don't think I'll be here.
You're out of town. I was saying, if you're in town, you're
No,
invited.
you
and you're
give
in the
that away
front
to
row.
someone.
Okay, so let's go one more. Eventually. Tim Irwin. Tim was in the back. I saw, there's Tim.
All right.
Well, thank you very much. Thank you everyone for attending. Please let us know what you thought, either with the form on your table or an email to us, and hopefully we'll see you at an event soon.